Before we begin, please note that the information provided in this video is for educational and informational purposes only. I am not a financial advisor, mortgage lender, or real estate professional. The content of this presentation is not intended to be a substitute for professional financial advice. You should always consult with a qualified and licensed professional before making any financial decisions, especially one as significant as purchasing a home. All examples used are hypothetical and for illustrative purposes. Your individual financial situation is unique, and the results you see from any calculator will vary. You've spent the last 6 months glued to your phone, every night after the kids are in bed, or during your lunch break you're scrolling Zillow, Redfin, Realtor.com. It's become a ritual. You've saved dozens of homes, created a Pinterest board, and you can practically smell the fresh paint in your imaginary home office. And then you see it. It's not just a house. It's the house. The one with the navy blue front door you've always wanted, the big, fenced-in backyard for the dog. And it's in that perfect school district you thought you'd never be able to afford. Your heart starts pounding. This is it. You call your agent, you tour the house, and it's even better in person. You can see your life unfolding there. So you do it. You write the offer. You cross your fingers, you barely sleep for 2 days, and then you get the call. They accepted your offer. You're ecstatic, you're calling your family, you're celebrating. And then the other call comes. The one from the mortgage lender. And the tone of their voice is different. They use words like debt-to-income ratio and qualifying limits. And then they drop the bomb. I'm sorry, but we can't approve the loan for that amount. The floor drops out from under you. The dream house is gone. And the only question you can ask is why? How could you have been so wrong about what you could afford? That exact scenario, that moment of pure financial heartbreak, is the #1 fear for almost every single person trying to buy a home in America today. And it happens far more often than you think. It happens because we, as homebuyers, are taught to look at the wrong things. We look at the list price. We look at the pretty pictures. We use our monthly rent as a baseline and think, well, I pay $2,000 in rent, so I can definitely afford a $2,000 mortgage. But that is a catastrophic mistake. That kind of thinking completely ignores the 4 invisible monsters of home buying: property taxes, homeowners insurance, private mortgage insurance, and your total existing debt. You see, the bank doesn't care what you think you can afford. They don't care about your budget spreadsheet or your gut feeling. They care about one thing and one thing only: risk. And they measure that risk using a cold, hard mathematical formula. The good news? That formula is no longer a secret. It's not locked away in some banker's vault. In fact, it's available to you right now for free. And the tool that uses it is called a mortgage qualification calculator. This is not the same as a simple mortgage payment calculator, which just tells you a monthly payment. A qualification calculator is infinitely more powerful. It's a financial crystal ball. It's the device that lets you see your home buying potential through the exact same lens as the lender. Using this tool correctly is the single most important thing you can do before you ever talk to a real estate agent, before you ever step foot in an open house, and certainly before you ever fall in love with a house you can't have. And in this video, I am going to pull back the curtain and show you, step by step, exactly how to use this tool like a seasoned pro. We're not just going to plug in numbers. You're going to understand what every single number means. We will break down your gross monthly income and why take-home pay is the wrong number to use. We will demystify the single most important acronym in real estate, DTI, or debt-to-income ratio. And I'll show you how to calculate yours in under 60 seconds. We'll talk about down payments and how a 20% down payment isn't always the smartest move. We'll cover credit scores, interest rates, and all those other hidden costs that can derail your dream. By the end of this video, you will no longer be guessing. You will have a precise, lender-approved price range. You will walk into the home buying process with a level of confidence that 99% of other buyers simply don't have. You'll be able to speak the language of lenders. You'll be able to spot a good deal. And you'll know instantly when a house is out of your reach, saving you months of wasted time and emotional energy. You will transform from a hopeful home shopper into a power buyer. An educated buyer. The kind of buyer that real estate agents love to work with and that sellers take seriously. So why should you listen to me? Because I've seen that heartbreak firsthand hundreds of times. I've seen the financial devastation that comes from making emotional decisions with incomplete information. And I've also seen the incredible success and wealth building that happens when people take a few moments to understand the fundamental mechanics of a mortgage. This isn't complicated. This isn't advanced calculus. This is simple arithmetic that anyone can master, and it's the key to unlocking the front door of your future home without the stress and the fear. The entire process of buying a home feels like a giant, intimidating mystery, but it's not. It's just a series of questions that you need to answer. And the mortgage qualification calculator is your answer key. It gives you the clarity you need to move forward. It takes this huge, terrifying number, the price of a house, and breaks it down into simple, manageable pieces that you already know. What you earn and what you owe. So if you're tired of dreaming and ready to start planning, you're in the right place. Grab a notepad or open up a spreadsheet because we're about to build your home buying blueprint from the ground up. We're going to do this together. We'll use a real live mortgage qualification calculator right here on the screen, and I'll walk you through every single box, every single option, and every single piece of jargon. No more confusion, no more anxiety. Just clarity and confidence. Let's start with the very first number the bank wants to know. The foundation of your entire home loan application. Your gross monthly income. Let's break down exactly what it is, where to find it, and the most common mistakes people make when entering it. This one number can dramatically change the kind of home you qualify for, so getting it right is absolutely critical. Let's dive in. The very first box you'll see on almost every mortgage qualification calculator is gross monthly income. And right here at the very first step is where 90% of people make their first and most costly mistake. It's a mistake born from a simple misunderstanding. A misunderstanding that can slash your perceived buying power by $30, $40, or even $50,000. It can be the difference between the 3-bedroom house in the good school district and the 2-bedroom condo next to the freeway. So what is gross monthly income? In the simplest terms, it's your total earnings before a single penny is taken out for taxes, health insurance, your 401k, or that office pizza fund. It's the big, impressive number at the top of your pay stub, not the smaller, slightly more depressing number that actually hits your bank account. That smaller number is your net income or take-home pay. Lenders don't care about your take-home pay. Let me say that again because it is the single most important concept we will cover in this section. Lenders, and therefore these calculators, only care about your gross income. Why? Because it's a standardized metric. Your tax situation is unique. Your healthcare choices are unique. Your retirement contributions are unique. The lender can't base the biggest financial decision of your life on variables they don't control. They need a consistent, top-line number to measure your fundamental earning power against everyone else's. Gross income is that number. So where do you find it? If you're a salaried employee who gets a regular paycheck, this is easy. Grab your latest pay stub. Look for a line item that says gross pay, total earnings, or something similar. It will be the highest number on the earnings side of the statement. If you're paid bi-weekly, multiply that number by 26 to get your annual gross, then divide by 12. If you're paid twice a month, multiply by 24 and divide by 12, or just multiply by 2. If you're paid weekly, multiply by 52 and divide by 12. Do the math to get your monthly figure. That's the number you put in the box. But what if your income isn't that simple? What if you're like millions of Americans whose pay isn't a fixed salary? This is where the real value is, and where you can gain a huge advantage by understanding how a lender actually thinks. Let's talk about overtime. You worked a ton of extra hours last month, so your paycheck was huge. Can you use that? The answer is maybe. A lender is looking for income that is stable and likely to continue. A one-time burst of overtime from a special project won't count. But if you can show a consistent 2-year history of earning overtime, the lender will likely average your overtime earnings from the last 24 months and add that monthly average to your base pay. You'll need W-2s and pay stubs to prove it, but yes, consistent overtime can absolutely boost your qualifying income. The same exact principle applies to bonuses and commissions. A surprise one-time Christmas bonus? That's great for you, but the lender won't count it. But if you're in a sales role and you've received a quarterly or annual bonus for the last 2 years, they will almost certainly average that income over 24 months and add it to your gross monthly income. This is huge. For a salesperson, their commission might be half of their total pay. Ignoring it on a calculator is like trying to buy a house with one hand tied behind your back. You need to gather your records for the past 2 years, calculate your average monthly commission, and add it to your base salary to get your true gross monthly income for that calculator. Now let's tackle the big one. What if you're self-employed? A freelancer, a gig worker, an independent contractor, or a small business owner? This is where the single biggest and most painful mistake is made. You might have invoiced $10,000 last month. That feels great. You might be tempted to put $10,000 into the calculator. Please do not do this. You will be setting yourself up for massive disappointment. For the self-employed, a lender doesn't look at your revenue. They don't look at what you invoiced or what clients paid you. They look at your net income. After all your business expenses have been deducted, where do they find this number? On your tax returns. Specifically, they'll look at your Schedule C, find your net profit or loss, and they will average that number over the past 2 years. So if in year 1 you netted $60,000 after expenses, and in year 2 you netted $70,000, they will add those together. That's $130,000, divide by 24 months, giving you a qualifying gross monthly income of about $5,416. It doesn't matter if you had a month where you billed $15,000. The only thing that matters is the net profit proven on your tax returns over a consistent period, usually 24 months. This is a hard pill to swallow for many entrepreneurs who are amazing at generating revenue, but also have significant business expenses. The key is to understand that the bank qualifies you based on the profit you've proven to the IRS, not the money that flows through your business account. What about a side hustle? Maybe you have a full-time W-2 job, but you also drive for a ride-sharing service or sell crafts online. The same rules apply. You can absolutely use that income to help you qualify, but only if you've been doing it for about 2 years and, critically, you've been claiming that income on your taxes. The lender will want to see the tax returns to prove it. They'll average the net profit from that side business and add it to the gross income from your primary job. This concept of a 2-year history is the golden thread that runs through all non-salary income. Lenders need to be confident that your income is not a fluke. They are lending you hundreds of thousands of dollars for 30 years. They need to see a pattern of stable, reliable, and documented earnings. So let's put this into practice. Let's imagine a nurse named Sarah. Her base salary is $72,000 a year, which is $6,000 a month. But she consistently works overtime, and when she looks at her last 2 W-2s, she sees she earned an extra $12,000 each year from that overtime. That's an extra $1,000 a month. So the number Sarah should put in the calculator isn't $6,000. It's $7,000. Now let's look at her husband, Ben. He's a freelance graphic designer. Last year was great, he billed $120,000. But after paying for software, his co-working space, and other business expenses, his net profit on his tax return was $84,000. The year before, it was $72,000. A lender will average those 2 years. $72,000 plus $84,000 is $156,000. Divide that by 24 months, and Ben's qualifying monthly income is $6,500. So when Sarah and Ben fill out the mortgage calculator, they don't guess. They don't use their take-home pay. They use their true lender-verified gross monthly income. Sarah's $7,000 plus Ben's $6,500 gives them a combined gross monthly income of $13,500. Let's see what a difference that makes. If they had made the common mistake and only used their base salaries and ignored Ben's full income history, they might have put in $10,000. At today's interest rates, that difference of $3,500 a month in qualifying income could easily be the difference between qualifying for a $400,000 home and a $600,000 home. It is that dramatic. Getting this one number right is the foundation of your entire home buying journey. It sets the boundaries of your search and manages your expectations. Take a moment right now. Pause and do the work. Don't just guess. Pull up your pay stubs. If you have them, pull up your last 2 years of W-2s or tax returns. Calculate your actual average gross monthly income the way a lender would. Add in your consistent overtime, your bonuses, your commissions. If you're self-employed, find your net profit and average it. Get a real number. This is the single most empowering thing you can do at the start of this process. Now that you have this number, your true documented provable income, you've built the engine of your mortgage application. But an engine is useless without knowing how much weight it can pull. The other side of this equation, the force working against your income, is your debt. Your monthly debt payments are the silent killer of mortgage approvals. It's not just about how much debt you have, but about a very specific, almost sacred ratio that lenders use to decide if you are a safe bet or a dangerous risk. Understanding and optimizing this ratio before you even talk to a lender is the next secret weapon in your arsenal. Let's break down exactly what it is. This ratio is called the debt-to-income ratio, or DTI. And I'm not exaggerating when I say this one number is the gatekeeper to your future home. It is the single most important metric lenders use to measure your financial health and your ability to handle a mortgage payment. Get this number right and the doors to homeownership swing wide open. Get it wrong and they slam shut, often without you even knowing why. So what is it? In the simplest terms, your DTI compares how much money you owe each month to how much money you make. It's a percentage, a snapshot of your financial obligations versus your income. Lenders look at this and think, okay, after they pay all their existing bills, how much room is left in their budget to comfortably afford a house payment? They don't want you to be house poor, stretched so thin that one unexpected car repair could cause you to miss a mortgage payment. Your DTI tells them exactly how much breathing room you have. Now, here's where it gets a little more detailed, but stick with me because this is crucial. There are actually two types of DTI that lenders calculate. First, there's the front-end ratio. This is also called the housing ratio. This number looks only at your potential new housing costs. It takes the total estimated monthly mortgage payment, and this includes the principal, the interest, the property taxes, and the homeowner's insurance, a package often called PITI, and it divides that by your gross monthly income. That's your income before any taxes or deductions are taken out. So if your estimated PITI is $2,000 and your gross monthly income is $6,000, your front-end DTI is 33%. Simple enough. But the second number is the one that really matters. This is the back-end ratio, and when you hear a lender talk about your DTI, this is almost always the one they're referring to. The back-end ratio takes all of your monthly debt obligations, that includes your new estimated housing payment, your PITI, and adds on everything else. We're talking car payments, student loan payments, the minimum monthly payments on all your credit cards, personal loans, any alimony or child support you pay, basically any recurring monthly debt that shows up on your credit report. It takes that grand total of monthly debt and divides that by your gross monthly income. This back-end number gives the lender a complete, panoramic view of your financial life. It tells them what percentage of your monthly income is already spoken for before you even buy groceries, pay for gas, or put money into savings. So let's make this real. Let's invent a person named Alex. Alex is looking to buy a home and wants to figure out if they can qualify. First step, gross monthly income. Alex has a good job and makes $72,000 a year. To get the gross monthly income, we divide that by 12. So $72,000 divided by 12 gives us $6,000 a month. That's our starting point, the denominator in our DTI equation. Second step, let's figure out Alex's debts. This is where you need to be brutally honest with yourself. Pull out your statements, log into your accounts, and list every single required minimum monthly payment. Let's say Alex has a car payment of $450 a month, a student loan payment of $300 a month, 3 credit cards. One has a minimum payment of $50, another is $40, and the third is $25. So that's $115 in total minimum credit card payments. So Alex's current, non-housing debt totals $450 plus $300 plus $115, which equals $865 per month. Keep that number in your back pocket. Now, the house Alex wants to buy would result in an estimated total monthly payment, the PITI we talked about, of $2,100. Okay, we have all the pieces. Let's calculate Alex's DTI ratios. First, the front-end ratio. We take the housing payment, $2,100, and divide it by the gross monthly income, $6,000. That gives us 0.35. As a percentage, Alex's front-end DTI is 35%. Now for the big one, the back-end ratio. We take the new housing payment, $2,100, and we add all of Alex's other monthly debts, which we calculated was $865. The total monthly debt obligation would be $2,965. Now we take that total and divide it by the gross monthly income of $6,000. That gives us 0.494. Let's round that up. Alex's back-end DTI is 49%. So what do these numbers, 35% and 49%, actually mean? This is where we get into the lender's rulebook. For decades, a general guideline for conventional loans was the 28 of 36 rule. This meant lenders preferred your front-end DTI, your housing expense, to be no more than 28% of your gross income, and your back-end DTI, all your debts, to be no more than 36%. Using that old rule, Alex would be in trouble. A 35% front-end is over the 28% limit, and a 49% back-end is way over the 36% limit. But here's the good news. Things have changed. lenders have become more flexible. That 28 of 36 rule is more of a dusty old guideline than a hard and fast law today. For most conventional loans, lenders can now comfortably accept a back-end DTI, all the way up to 43%. Sometimes, if you have what are called compensating factors, like a very high credit score, a large down payment, or significant cash reserves, they might even stretch it to 45 or 47%. And for certain types of government-backed loans, like an FHA loan, the limits can be even more generous. It's not uncommon to see approvals with a DTI of 50% or even slightly higher in some cases. So, where does our friend Alex stand with that 49% DTI? For a conventional loan, Alex is likely on the edge or just over it. They would probably be denied or told they need to look for a less expensive house. For an FHA loan, they might just squeak by, but it would be tight. This is the entire reason the mortgage qualification calculator exists. When you punch in your income and your monthly debts, this is the exact calculation it's running in the background. It's taking your debts, adding an estimated PITI for the home price you entered, and checking to see if the resulting DTI percentage falls within the acceptable range for the loan type you've selected. It's a DTI simulator. Understanding this process is like being given the answers to the test ahead of time. You now know that every single dollar of monthly debt you carry directly reduces the amount of house you can afford. That $450 car payment isn't just $450 a month. In the eyes of a lender, it could be reducing your home buying power by $75,000 or more. It's that impactful. So take a moment and do this for yourself. Calculate your gross monthly income. Then go on a scavenger hunt for your debts. List every single minimum payment. Be honest. Don't leave anything out. Total it all up. This is your starting point. This is your raw data. Now, I know what some of you might be thinking. You've just done the math, you've seen your own DTI number, and your heart just sank a little. Maybe your number is like Alex's at 49%, or maybe it's 55%, or even 60%, and you might be feeling like homeownership is impossible. I want you to stop that thought right there, because knowing your number, even if it's a high number, is not a dead end. It's a starting line. It's the most powerful piece of information you can have, because now you know exactly what you need to fix. That number isn't a judgment, it's a target. And the next step isn't to give up, it's to strategize. It's time to go on a DTI diet. There are specific, powerful, and sometimes surprisingly simple ways to attack that number and bring it down, dramatically increasing your borrowing power in the process. And that is exactly what we're going to break down next. So let's put you on that DTI diet. But forget about counting calories or giving up carbs. This diet is about financial fitness, and the goal isn't to get leaner. It's to get stronger, financially stronger. The first thing to understand is that your DTI ratio has two, and only two core components. The D for debt, and the I for income. That's it. To lower the final number, your DTI percentage, you have two levers you can pull. You can either decrease the debt or you can increase the income. Sounds simple, and it is. But the strategies behind pulling those levers are where the magic happens. Let's start with the debt side first, because for most people, this is where you can make the fastest and most impactful changes. Think of this as your workout plan. There are different styles, and you need to pick the one that fits you. The two most famous methods for tackling debt are the debt snowball and the debt avalanche. The debt snowball method is all about psychology and momentum. You list all of your debts, from the smallest balance to the largest, regardless of the interest rate. You make the minimum payment on everything, but you throw every single extra dollar you can find at that smallest debt. You attack it with a vengeance. Once it's paid off, you take the money you were paying on that debt, including the extra, and you roll it all into the payment for the next smallest debt. Each time you pay one off, the snowball of money you're throwing at the next debt gets bigger and bigger. The feeling of knocking out those small debts one by one creates an incredible sense of progress and keeps you motivated. It's like clearing the small, annoying pebbles off a path before you try to move the big rocks. Then there's the debt avalanche. This method is for the pure mathematicians. You list your debts not by size, but by interest rate, from the highest to the lowest. Again, you make minimum payments on everything, but you throw all your extra cash at the debt with the highest interest rate. This is usually a credit card. While it might take longer to get your first win, this method will save you the most money in interest over the long term. It's less about emotional victories and more about pure financial efficiency. It's like deciding to move the biggest, heaviest rock first because you know that once it's gone, everything else will be easier. Which one is better? The one you'll actually stick with. But for the purpose of qualifying for a mortgage, both have the same powerful effect. They eliminate monthly payments from your DTI calculation. Every single time you pay off a credit card, a personal loan, or a medical bill, you are not just clearing debt, you are buying back your borrowing power. You are literally giving yourself a raise in the eyes of the lender. Now let's talk about a silent killer of borrowing power: the minimum payment trap. Lenders don't care if you have a $10,000 credit card balance. What they care about is the minimum monthly payment that shows up on your credit report. Let's say it's $200. That $200 is treated the exact same way in their calculation as a $200 car payment. It's a $200 obligation that reduces how much house you can afford, month after month. Paying only the minimum on your cards is like trying to run a marathon while wearing a weighted vest. You can do it, but it's exhausting, slow, and you'll never reach your full potential. Aggressively paying down those balances, or better yet, paying them off, is like taking that vest off. Suddenly you can run faster and farther. And that brings me to the single biggest DTI killer I see day in and day out. The one thing that single-handedly crushes more homeownership dreams than almost anything else: the car loan. We live in a car culture, and it's easy to see a $600, $700, or even $800 car payment as just a normal part of life. But to a mortgage underwriter, that car payment is a financial anchor dragging your qualification amount down to the depths. Let's imagine two people, we'll call them Alex and Ben. Both make exactly $75,000 a year. Both have great credit. Both have about $500 in credit card and student loan payments each month. They are identical financial twins in every way, except for one. Alex drives a brand new SUV with a $700 monthly payment. Ben drives a reliable 10-year-old sedan that he owns free and clear. It's paid off. No payment. When Alex goes to the mortgage calculator and plugs in his numbers, that $700 car payment is a massive liability. The calculator, using standard lending rules, might tell him he can afford a house worth around $250,000. He's disappointed. It's not what he was hoping for. Then Ben, his financial twin, plugs in his numbers. The exact same income, the exact same credit card and student loan debt. But where the car payment goes, he enters zero. The result? The calculator tells him he can qualify for a mortgage of around $375,000. That is a $125,000 difference in buying power. That's not a small gap. That is a life-changing chasm. It's the difference between a small condo and a single-family home. The difference between being in your dream neighborhood or being 20 miles away. All because of a car payment. I'm not saying you have to sell your car, but you have to understand the staggering trade-off you are making. That $700 payment isn't just costing you $700 a month. It's costing you over $100,000 in the home you can provide for yourself and your family. Okay, so that's the debt side of the equation. Attack it with a plan, understand the trap of minimum payments, and be brutally honest about the cost of your car loan. Now let's flip the coin and look at the other lever: increasing your income. This side is often slower and harder to change, but it's just as powerful. The most important rule here is documentation. A lender will not, under any circumstances, just take your word for it. If you can't prove it on paper, it doesn't exist. For those of you with a standard W-2 job, this is pretty straightforward. The lender will look at your pay stubs and W-2s. A recent raise is fantastic because it's documented, stable, and predictable. But what if you're part of the gig economy? A freelancer, a contractor, or a small business owner? This is where things get tricky. For any income that isn't from a traditional employer, lenders will almost always want to see a 2-year history. They want to see 2 full years of tax returns showing that income. So if you just started a killer side hustle 3 months ago that's bringing in an extra $2,000 a month, that's amazing for your budget, but it's invisible to a mortgage lender. It doesn't count. Not yet. You need to season that income. You need to build a track record. This means if you're planning to buy a house in the next couple of years, the absolute best thing you can do right now is meticulously document every single dollar you earn and, crucially, report it on your taxes. That side business you run for cash? It might feel good to have that tax-free money in your pocket now, but it's doing absolutely nothing to help you qualify for a home loan. In the world of mortgages, undocumented income is a ghost. Let's go back to our friend Alex, the one with the big car payment. Let's say he can't get rid of the car. But for the last 2 years, he's also had a documented side gig designing websites, bringing in an average of $1,000 a month. That's $12,000 a year in extra, provable income. When he adds that to his $75,000 salary, his total qualifying income jumps to $87,000. Now let's plug that back into the calculator. We have his higher income, but we still have that killer $700 car payment. The result? His borrowing power jumps from $250,000 all the way up to around $310,000. He still isn't at Ben's level, but he just added $60,000 to his home budget, simply by having the foresight to document his hard work. This is the power of the DTI diet. It's a game of numbers. You push one number down, another number goes up. You find ways to strategically and legally push your income number up, and your borrowing power follows suit. It's not about luck. It's about a deliberate, focused strategy. It's about understanding that the small financial decisions you make every single day, the debt you take on, the income you document, are building the foundation for the biggest purchase of your life. But even with a squeaky clean DTI, a ratio that a lender would drool over, there's another number that acts as the ultimate gatekeeper. A 3-digit score that can either unlock the best interest rates imaginable or slam the door shut in your face, no matter how good your income or debts look. Your credit score. And the myths, misunderstandings, and downright bad advice surrounding that score can cost you tens of thousands of dollars over the life of your loan. We're going to unravel all of it. Let's start with the biggest lie you've been told about your credit score. The lie is that you have one. You don't. The score you see when you log into your credit card app, or the one from a free credit monitoring service. That's almost certainly not the score your mortgage lender is going to see. It's not even close. And this single misunderstanding is where so many home buying dreams begin to crumble. You see, those free services typically show you a score called a VantageScore. It's a great educational tool. It helps you track your progress. But mortgage lenders don't use it. They use a much older, more conservative, and frankly tougher scoring model called the FICO score. And not just any FICO score. For mortgages, they specifically use FICO Score 2, FICO Score 4, and FICO Score 5. These are the old-school, heavyweight champions of the credit world. They were built specifically to assess the risk of lending someone hundreds of thousands of dollars for 30 years. They are less forgiving than the newer models you see for free. They weigh certain things more heavily, and they don't care about your recent good behavior as much as your long-term track record. So when you apply for a mortgage, your lender pulls your credit report from all 3 major bureaus: Equifax, Experian, and TransUnion. They get 3 different scores, one from each bureau, using these specific FICO models. Now, what do they do with those 3 numbers? Do they average them? Do they take the highest one? No. They throw out the highest score, they throw out the lowest score, and they use the one that's sitting right in the middle. This is called your representative, or middle score. So, if your scores come back as a 721, a 745, and a 733, your lender doesn't care about the stellar 745. They don't care about the 721. Your qualifying credit score is 733. That is the number that dictates everything. Now, what if you're applying with a partner? A spouse, a significant other? Gets even tougher. The lender pulls all 3 scores for both of you. They find your middle score, and they find your partner's middle score. Then they take the lower of those 2 middle scores. That's right. You are only as strong as your weakest link. If your middle score is a pristine 780, but your partner's is a 679, you are a 679 borrower in the eyes of the bank. Period. The entire loan application, your interest rate, your mortgage insurance, it all hinges on that lower score. This is why, when you get to that credit score field in the mortgage qualification calculator, just guessing or plugging in your VantageScore is like flying blind. You need to understand the tiers that lenders use, because a single point can be the difference between a great interest rate and a painfully expensive one. Think of it like this. Generally speaking, a score of 740 or higher puts you in the top tier. You're getting the best interest rates, the lowest fees, the red carpet treatment. From 700 to 739, you're still in great shape, very solid. From 680 to 699, you're considered acceptable to most lenders, a standard borrower. But once you dip below 680, things start to change. The rates get a little higher. The requirements get a little stricter. Below 640, it becomes significantly more challenging to get a conventional loan, and you might be looking at different loan programs with higher costs. Let's put this into real dollars because that's what really matters. Let's imagine a $400,000 loan. Sarah has a 760 middle FICO score. She's top tier. The lender offers her an interest rate of 6.5%. Her monthly principal and interest payment is about $2,528. Now let's take Mark. He's got a 679 middle FICO score. He just missed that 680 threshold. He's seen as a slightly higher risk. The lender offers him the same $400,000 loan, but at a 7.5% interest rate. His monthly payment is $2,797. That's $269 more every single month. That's over $3,200 a year. But it gets so much worse. Over the 30-year life of the loan, Sarah, with her excellent credit, will pay about $510,000 in total interest. Mark, with his just okay credit, will pay a staggering $607,000 in interest. That's a $97,000 difference. $97,000. For a few points on a credit score. That's a brand new luxury car. That's a college education. That's a life-changing amount of money, determined by a number that most people don't even truly understand. So how do you make sure you're Sarah, not Mark? You have to stop listening to generic credit advice and start thinking like a mortgage underwriter. There are 3 huge myths that can absolutely torpedo your mortgage score. First is the myth that you should close old credit cards you don't use. This is terrible advice before a mortgage. A huge part of your score is your average age of accounts. If you have a credit card you opened 10 years ago, even if you never use it, it's a wise old anchor for your credit history. Closing it is like chopping down an old tree in your yard. It makes your whole history look younger and less stable, and your score will drop. Also, closing a card reduces your total available credit, which instantly increases your credit utilization ratio. Another massive factor. Don't close any accounts for at least a year before you plan to buy a home. The second, and this one is controversial, is the myth that you should immediately pay off old collection accounts. This feels responsible, right? But it can backfire spectacularly. When you pay an old medical bill or a forgotten utility collection, the collection agency updates the account with the credit bureaus. This new activity can make a dormant, forgotten negative item suddenly look fresh and new on your report, causing your score to plummet right when you need it to be highest. The rule is this: do not touch any collection accounts without first talking to your mortgage lender. They can run simulations and advise you on the exact right way to handle it, which sometimes means leaving it alone. And the third myth is that all debt is created equal. An underwriter looks at a $15,000 car loan very differently than $15,000 in credit card debt. The car loan is an installment loan. It has a fixed payment and a fixed end date. As long as you're paying it on time, it shows you can handle debt responsibly. But $15,000 spread across 3 credit cards with high balances? That's revolving debt, and it's a huge red flag. It signals to the lender that you might be living beyond your means. The single fastest way to boost your score before applying for a mortgage is to aggressively pay down your credit card balances to below 30% of their limits, and ideally below 10%. It has a much bigger impact than paying extra on your car loan or student loans. So back to our calculator. When you see that box for credit score, what do you put in? You don't put the 780 you see on your free app. You need to be more realistic, more conservative. If you haven't had a lender pull your true mortgage FICO scores, a good rule of thumb is to estimate about 20 to 40 points lower than what your free Vantage score says. So if your app says 750, try running the numbers at 720. See what happens to your qualifying amount, to your estimated interest rate. This dose of realism is the first step to creating a plan that actually works. Because a plan based on a fantasy number is doomed to fail. Your credit score is the gatekeeper. It determines if you're even allowed into the game, and what rules you have to play by. But even with a perfect 800 score and an amazing debt-to-income ratio, there's one final hurdle that trips up more aspiring homeowners than everything else combined. It's the one thing that calculators have the hardest time estimating: cash. Not just your down payment. We're talking about the hidden costs, the surprise fees, the money you need in the bank after you get the keys, the things nobody seems to talk about until you're staring at a closing statement in a panic. And that's exactly what we're going to break down next. Let's start with the big one. Closing costs. This is the term that gets thrown around, but it's a black box for most people. Think of it like this: buying a house isn't like buying a TV. You don't just scan a barcode and walk out. It's a massive legal and financial transaction involving a dozen different people. Lawyers, appraisers, government clerks, insurance agents, and every single one of them needs to get paid for their time and services. Closing costs are simply the bundle of all those service fees. The number one mistake people make is thinking their down payment is the only cash they need. They save up 20% or 5% or whatever their goal is, they get pre-approved, they find a house, and then 2 weeks before they're supposed to get the keys, their lender hands them a document called a loan estimate. And on that document is a number, usually in the thousands or tens of thousands of dollars, labeled estimated closing costs. And that's when the heart-stopping panic sets in, because they didn't budget for it. They didn't even know it existed. So let's open the black box. What are you actually paying for? First, you have lender fees. The most common one is the loan origination fee. This is the lender's fee for the work of actually creating and processing your loan. It's their paycheck for the administrative work, the underwriting, the pulling of documents. It's typically around 0.5% to 1% of the total loan amount. So on a $400,000 loan, you could be looking at $2,000 to $4,000 right there, just to say thank you to the bank for lending you the money. Next up are the third-party fees. This is where the list gets long. You'll have an appraisal fee. Before a bank gives you hundreds of thousands of dollars, they want to be damn sure the house is actually worth that much. So they hire an independent appraiser to go out, inspect the property, compare it to other recent sales in the area, and give an official valuation. You pay for that. It can be anywhere from $400 to $800, or even more for a complex property. Then there's title insurance. This one is hugely important and wildly misunderstood. Title insurance protects you, and more importantly, it protects the lender from any past problems with the house's ownership. What if the person who sold the house to the person you're buying it from forged a signature? What if there's a long-lost heir who suddenly shows up with a claim to the property? What if there's an unpaid tax lien from a decade ago? Title insurance is a one-time premium you pay that says, "We've researched the entire history of this property's ownership, and we guarantee it's clean. If we're wrong, we'll pay to fix it." The lender will absolutely require you to buy a policy for them, and it's highly recommended you buy one for yourself as well. This can easily cost over $1,000. You'll also see fees for a credit report, flood certification to see if the property is in a flood zone, and various other administrative or processing fees. But the next big category is what's called prepaids and escrow. This is probably the most confusing part of closing costs for first-time buyers. When you own a home, you have to pay property taxes and homeowners insurance. Lenders don't trust you to save up for these big annual bills on your own. They worry that if you forget to pay your property taxes, the county could put a lien on the house, a house they technically own most of. So they set up an escrow account. Think of it as a forced savings account that they manage for you. Every month, a portion of your mortgage payment doesn't go towards your loan. It goes into this escrow account. Then, when the tax bill or the insurance bill is due, the lender pays it for you out of that account. At closing, they need to see this account with enough money to get it started. You might have to prepay for an entire year of homeowners insurance up front, plus deposit 2 to 3 months of property taxes into the escrow account. On a $400,000 house, your annual property taxes could be $6,000 and your insurance $1,200. Seeding that escrow account could mean coming up with another $2,000 or $3,000 in cash at closing. So let's add it up. Origination fees, appraisal, title search, insurance, recording fees, and pre-funding your escrow account. How much does it all cost? The general rule of thumb is that closing costs will be between 2% and 5% of the purchase price of the home. Let's take a $400,000 house. 2% is $8,000. 5% is $20,000. That's $8,000 to $20,000 in cash you need to bring to the table in addition to your down payment. Suddenly, that 5% down payment of $20,000 doesn't look so simple. You actually need your $20,000 down payment plus, let's say, $12,000 for closing costs. You need $32,000 in cash, not $20,000. This is the number that derails dreams. This is the number our simple mortgage calculator doesn't tell you about. But wait, I'm sorry to say this, but it gets even tougher. Because even after you've paid your down payment, and you've paid your $20,000 in closing costs, the lender still isn't satisfied. They have one more requirement, and it's the one that nobody ever sees coming. It's called cash reserves. Cash reserves are the money the lender wants to see left in your bank account after the deal is done. After you've spent every penny on the down payment and closing costs. This is your emergency fund. The lender needs to know that if you lose your job the month after you move in, or if the furnace dies in the middle of winter, you won't immediately default on your first mortgage payment. They need to see a cushion. How much of a cushion? The standard is typically between 2 and 6 months worth of your total monthly housing payment. And by total payment, I mean pity. principal, interest, taxes, and insurance. So let's go back to our example. Let's say on that $400,000 house, your total pity payment is calculated to be $2,800 per month. If the lender requires 2 months of reserves, they want to see proof that you will have $5,600 in a checking or savings account on the day you close. If they are more conservative and require 6 months of reserves, that's almost $17,000. Now do you see the full picture? The online calculator told you that you could afford a $400,000 house. You saved up $20,000 for a 5% down payment. You felt ready. But the reality is you need $20,000 for the down payment, plus let's say $12,000 for closing costs, plus let's say $8,400 for 3 months of cash reserves. The real amount of cash you need to have in the bank isn't $20,000. It's over $50,000. That is more than double what most people plan for. This is where the game is really played. It's not about your monthly payment. It's about the massive pile of cash you need just to get in the door. The qualification calculator is a starting point, a tool to gauge your monthly budget, but it completely ignores the massive upfront capital that the real world of lending demands. So when you use that calculator, I want you to perform a second calculation on your own. Take the home price it gives you. Calculate your down payment. Then, separately, estimate 3% of the home price for closing costs. Then, estimate what your pity will be and multiply that by 3. Add those 3 numbers together. That is your real savings goal. That is the number that stands between you and a set of keys. Ignoring this is how you end up heartbroken, scrambling for money from family, or having to pull out of your dream home deal at the last minute, potentially losing your deposit. It's the single biggest financial shock in the entire home buying process. But now you know. You're ahead of 90% of the people out there who are just plugging numbers into a website and dreaming. You understand the true cost of entry, but the cash you have on hand is only one half of the equation. The other half, the one that works in the shadows, is your debt. You could have $1 million in cash, a perfect credit score, and still be denied a mortgage because of one single all-powerful number. A number most people don't even know how to calculate. It's called the debt-to-income ratio, and it is the gatekeeper of the entire lending world. It's the silent killer of mortgage applications. And in the next part, we're going to dissect it, master it, and turn it into your secret weapon. So, what exactly is this number that holds so much power? Imagine your total monthly income before taxes is a big, freshly baked pie. The debt-to-income ratio, or DTI, is simply the percentage of that pie you've already promised to other people. It's the slice that belongs to your car loan, your student loans, and your credit card companies. Lenders look at this number more intensely than anything else because it tells them how much pie is left over for them, for your new mortgage payment. It's a direct measure of your capacity to take on new debt. Get this number wrong and your dream home stays a dream. But understand it and you hold the keys to the kingdom. Now here's where most people get tripped up. There isn't just one DTI. Lenders are actually looking at 2 different numbers and you need to pass both tests. They call them the front-end and the back-end ratios. Let's start with the front-end ratio. This one is simple. It's also called the housing ratio because it only looks at your potential housing costs. It takes your future all-in mortgage payment, and that means principal, interest, taxes, and insurance, what we call pity, and it divides that by your gross monthly income. So if your estimated total mortgage payment is $2,000 a month, and your gross income is $6,000, your front-end DTI is 33%. It's a basic check to make sure the house itself isn't going to completely overwhelm your budget. It's important, but it's just the opening act. The main event, the number that truly makes or breaks your application, is the back-end ratio. This is the big one. The back-end DTI takes everything into account. It's your proposed new mortgage payment plus all your other monthly debt obligations, all divided by that same gross monthly income. And what counts as a debt? Think of any recurring payment that shows up on your credit report. Your car payment, that's in. Minimum monthly payments on all your credit cards, even if you pay them off every month, they're in. Student loan payments? Absolutely. Personal loans, child support, or alimony payments? Yes, those count too. Let's make this real. Meet Alex and Sarah. Together, they make $120,000 a year, which is $10,000 a month in gross income. They found a house they love, and the estimated all-in pity payment is going to be $3,000 a month. That gives them a front-end DTI of 30%. Looks pretty good, right? They're feeling confident. But now let's look at the back end. Alex has a $400 a month car payment. Sarah has $600 a month in student loan payments, and together they have 3 credit cards, and the minimum required payments on those cards add up to $150 a month. So, we take their new $3,000 mortgage payment, we add the $400 car payment, the $600 student loan, and the $150 in credit card minimums. Their total monthly debt obligation is $4,150. We divide that by their $10,000 monthly income. Their back-end DTI is 41.5%. Suddenly, that comfortable 30% front-end ratio doesn't matter as much. Everything hinges on this 41.5% number. To a lender, this isn't just a percentage. It's a bright, flashing light that indicates risk. It tells them that for every dollar Alex and Sarah earn before taxes, nearly 42 cents is already spoken for. The lender's only question is there enough buffer left if something goes wrong? If the car breaks down? If one of them gets sick? This is why DTI is the gatekeeper. It's not about how much money you have in the bank. It's about how much of your monthly cash flow is already committed. So what are the magic numbers? What DTI are lenders actually looking for? For decades, the gold standard was something called the 28 of 36 rule. This meant lenders wanted to see a front-end housing ratio no higher than 28% and a back-end total debt ratio no higher than 36%. This was a very conservative, very safe benchmark. And while it's a great goal to aim for personally, the reality of the modern housing market is that these numbers are often unrealistic for most first-time buyers. The most important number you need to burn into your memory today is 43%. 43% back-end DTI is the line in the sand for most conventional loans. Why? Because it's the general limit set for something called a qualified mortgage. A qualified mortgage is a category of loans with features that make them more stable and less risky for you, the borrower. And because they're considered safer, lenders love them. For many lenders, if your DTI is 43.1%, their automated underwriting system will just spit out a denial. It's a hard and fast rule. It's a brick wall. But what if you're like Alex and Sarah, sitting at 41.5%? You're getting close to that wall. A slightly higher interest rate or property tax assessment could push you right over the edge. This is where so many aspiring homeowners get a heartbreaking rejection and have no idea why. They were pre-approved, they found a house, and then in final underwriting something small changed, their DTI ticked over that 43% threshold and the loan was denied. Now, is 43% the absolute final limit? No. And this is where the insider knowledge really comes into play. Different loan programs have different rules. Government-backed loans like an FHA loan are famous for being more flexible with DTI. An FHA loan might allow you to go up to 47% or even 50% without too much trouble. In some cases, with what are called compensating factors, an FHA loan might even stretch all the way to 56.9% DTI. What are compensating factors? Things like having a huge amount of cash in savings after closing, making a larger than required down payment, or having an exceptional credit score. It's you proving to the lender that even though your DTI is high, you have other strengths that make you a safe bet. VA loans for veterans can also be very flexible, sometimes not even having a strict DTI limit at all, focusing instead on something called residual income. This is exactly what the mortgage qualification calculator is doing behind the scenes. When you enter your income and your monthly debts, it's not just doing simple math. It's running your front-end and back-end DTI calculations instantly. It's simulating the lender's automated underwriting system. It's comparing your profile against these hidden thresholds, the 43% wall for conventional, the 50% ceiling for FHA. It's stress testing your financial life. And this is how we turn this concept into your secret weapon. Your weapon is knowledge. It's the power to stop guessing and start strategizing. Before you even talk to a lender, you can see exactly where you stand. You can see how dangerously close you are to that 43% wall. But more importantly, you can start playing with the numbers. You can see in real time how your borrowing power changes. You can ask yourself, what if I paid off that last $2,000 on my car loan? That would eliminate that $400 monthly payment. You plug that into the calculator, and suddenly your DTI for Alex and Sarah drops from 41.5% all the way down to 37.5%. That 4% drop is monumental. It's the difference between a nail-biting, borderline approval and a confident, stress-free green light. It's the difference between being forced to buy a smaller home in a less desirable neighborhood and having the power to compete for the house you actually want. That's not just a number. That's a life-changing shift in negotiating power. All because you understood the gatekeeper's secret code. We've mastered the what and the why of DTI. We understand the ratios, the thresholds, and the devastating impact they can have. But now comes the most important part. The how. How do you actively lower your DTI? How do you manipulate this number legally and ethically to unlock tens or even hundreds of thousands of dollars in borrowing power? In the next part, we're going to dive into the 5 most effective strategies to slash your DTI, starting with the one that almost nobody talks about, but often has the biggest and fastest impact. And that strategy, the one that can unlock tens, even hundreds of thousands of dollars in buying power almost overnight, revolves around a single line item on your credit report that lenders often get wrong. I'm talking about student loans. This is a huge one. So many people get unfairly penalized because of how lenders are required to calculate your student loan payment for your DTI. Let's say you have $100,000 in federal student loans, and you're on an income-driven repayment plan or IDR, so your actual monthly payment is only, say, $50. You might think, great, they'll just use $50 in my DTI calculation. Wrong. For conventional loans, Fannie Mae and Freddie Mac have rules. If your credit report shows a monthly payment greater than 0, they'll use that number. But if it shows a $0 payment, which is common for some IDR plans or forbearances, they can't just use 0. Instead, they're often required to use a hypothetical payment, typically 0.5% of your total loan balance. So for that $100,000 loan, they would hit your DTI with a $500 monthly payment, even though you're only paying $50 or maybe even nothing at all. Think about that. That's an extra $450 of phantom debt appearing on your application every single month. At a 45% DTI limit, that single miscalculation could reduce your borrowing power by $1,000 a month, which translates to a staggering $150,000 to $200,000 less in mortgage qualification. FHA and VA loans have similar, sometimes even stricter rules. So what's the fix? Surprisingly simple. You need to provide the lender with documentation that proves your actual monthly payment. You go to your student loan servicer's website, download a statement that clearly shows your name, the loan account number, and your actual required monthly payment under your specific repayment plan. You give this document to your loan officer and explicitly state, "Please use this documented payment for my DTI calculation, not the estimated percentage." A good loan officer will know exactly what to do. This one move can instantly correct your DTI and dramatically increase the amount you qualify for. It costs nothing, takes maybe 15 minutes, and it can be the single difference between getting the house you want and not qualifying at all. Okay, that was the big one, but let's not stop there. Here's strategy number 2, the mortgage velocity method for debt payoff. You've probably heard of the debt snowball, where you pay off your smallest debts first for psychological wins, or the debt avalanche, where you pay off your highest interest debts first to save money. For mortgage qualification, both are wrong. We don't care about the balance size, and we don't really care about the interest rate. We care about one thing and one thing only, the monthly payment. Your goal is to eliminate the highest monthly payments as quickly as possible. Take a look at all your debts. Credit cards, personal loans, car loans. Find the one with the highest monthly payment that you can realistically pay off in the next 3 to 6 months. Maybe it's a $2,000 personal loan with a $200 monthly payment. That's your target. Forget the $10,000 credit card with a $150 minimum payment for now. Every dollar you have should be thrown at that personal loan. Once it's paid off, poof, that $200 payment is completely gone from your DTI calculation. That single action just freed up over $400 in monthly mortgage payment power. It's about getting the biggest DTI reduction for every dollar you pay off. It's not about interest, it's about velocity toward your qualification goal. Strategy number 3 is a close cousin to this, and it's especially powerful for your auto loan. This is the strategic refinance. Let's say you have a car loan with 2 years left and a $600 monthly payment. That is a DTI killer. Many people think they're stuck with it, but you could potentially refinance that auto loan. Now, normally you refinance to get a lower interest rate, but here our goal is different. We might be willing to accept the same or even a slightly higher interest rate if we can extend the term of the loan. Instead of a 2-year loan, you refinance it into a new 5 or 6-year loan. Your $600 payment could instantly drop to $300. Yes, you'll be paying on the car for longer, but look what you just did for your mortgage application. You just freed up $300 in monthly DTI. That could boost your home buying budget by $60,000 or $70,000. It's a temporary trade-off. Once you're in your house, you can always start making extra payments on that car loan to pay it off faster. But for the crucial snapshot in time when you're applying for the mortgage, this move can be a complete game changer. Now, we've spent a lot of time talking about the D and DTI, the debt. Let's talk about the I, the income. Strategy number 4 is about maximizing your provable income. The key word there is provable. The bank doesn't care if you had a great month in your side hustle last month. They care about consistent, documented income, usually over a 2-year period. If you have a side business, freelance income, or even a part-time job, start documenting it meticulously now. Keep clean records. Deposit all earnings into a separate bank account. If you're a W-2 employee who gets bonuses or commissions, make sure your loan officer gets the documentation to show a 2-year history of you receiving them. Lenders can often average that variable income out over 24 months and add it to your monthly qualifying income. An extra $500 a month in provable, averaged income is just as powerful as eliminating $500 in debt. It has the exact same positive effect on your DTI ratio. Don't leave money on the table just because it's not part of your base salary. Finally, strategy number 5, the consolidation knockout. This is for those of you juggling multiple credit card payments. Let's say you have 3 cards, each with a balance, and your total minimum payments add up to $350 a month. This clutters your DTI. The knockout punch is to take out a single fixed-rate personal loan to pay off all 3 cards. You might be able to get a loan where the monthly payment is only $250. You just wiped out 3 separate payments, simplified your financial life, and most importantly for our purposes, you just dropped your monthly debt obligation by $100. That's another $20,000 in buying power just like that. And as a bonus, by paying off revolving credit card debt with an installment loan, you'll likely see a nice bump in your credit score as your credit utilization plummets, which is a perfect lead-in to our next topic. Because you can do all of this. You can fix your student loan calculation, use the mortgage velocity method, refinance your car, document your income, and consolidate your credit cards. You can slash your DTI from a dangerous 48% all the way down to a stellar 32%. But what if you do all that and you're still getting blocked by that 3-digit number? Your credit score. There is a very common mistake that I see 90% of homebuyers make in the 3 to 6 months before they apply for a mortgage. An innocent mistake that can actually drop their score right when they need it to be at its peak. In the next part, I'm going to show you exactly what that mistake is, and more importantly, how to use a little-known credit hack to potentially add 30, 50, or even 70 points to your score in as little as 45 days. So, what is this colossal mistake that so many responsible, well-intentioned people make? It's a mistake born from a good habit. Using a credit card for points and paying it off every month. You might be thinking, wait, that's what every financial guru tells you to do. How can that possibly be a mistake? And you're right, it's a fantastic habit for your long-term financial health. But in the 90 days leading up to a mortgage application, it can be an absolute credit score killer. Let me paint a picture for you. Meet Jessica. Jessica is a model of financial responsibility. She has a Visa card with a $10,000 limit. This month, she's doing some home improvements before she plans to sell and buy a new place. She goes to the hardware store and spends $4,000 on new flooring and paint. She puts it all on her Visa to get those sweet, sweet airline miles. A few weeks later, her credit card bill arrives. The statement balance is $4,000. The due date is the 25th. Like clockwork, on the 24th, Jessica pays the entire $4,000 balance. She pays 0 interest. She gets her airline miles. She feels like she's winning the game. But here's what she doesn't see. The day after her big shopping trip, her credit card company took a snapshot of her account. That snapshot showed a balance of $4,000 on a $10,000 limit. That's a 40% credit utilization ratio on that card. That snapshot is what they sent to the credit bureaus, Experian, TransUnion, and Equifax. The credit bureaus don't see that she paid it off by the due date. They don't see her good intentions. They see a single data point, 40% utilization. High utilization is a huge red flag for risk. It's a primary ingredient in 30% of your entire FICO score. So, even though Jessica paid it all off and did everything right, her credit score just plummeted by 35 points. And the worst part? She has no idea. A week later, she walks into a lender's office, they pull her credit, and the interest rate they offer her is significantly higher than she expected, costing her tens of thousands of dollars over the life of the loan. This is the trap. The single biggest, most devastating, and most common mistake is confusing your payment due date with your statement closing date. The world teaches you to care about the due date to avoid interest. But the credit scoring system only cares about the balance on your statement closing date. So how do we fix this? How do we use this knowledge to our advantage and turn it into one of the most powerful credit hacks in existence? It's deceptively simple, and it's what I call the prepayment method. Here's exactly what you're going to do. Right now, I want you to log into every single one of your credit card accounts online. For each card, you need to find one piece of information: the statement closing date. It's not the due date. It's usually listed right on your monthly statement PDF. Find that date for every card you have. Let's say your Visa closes on the 15th of the month, and your Amex closes on the 20th. Now, pull out your phone and open your calendar. For your Visa, I want you to set a recurring monthly reminder for the 12th, 3 days before the statement date. And for your Amex, set a recurring reminder for the 17th, 3 days before its statement date. The title of that calendar event should be Pay Credit Card. From now on, this is your new payment date. When that reminder pops up on your phone, you are going to log into your credit card account and pay the entire current balance down to zero. Not the statement balance from last month, but the full, up-to-the-minute balance of what you owe right then. What happens when you do this? Let's go back to Jessica. She still buys her $4,000 worth of flooring. But now, she has a reminder on her calendar. 3 days before her statement is scheduled to close, she logs in. She sees her current balance is $4,000. She pays the entire $4,000. A few days later, her credit card company takes its snapshot to send to the bureaus. But now, what does the snapshot show? It shows a balance of $0 on a $10,000 limit. That's 0% utilization. Instead of her score dropping 35 points, it actually increases. She walks into that lender's office, they pull her credit, and she gets the absolute best interest rate possible. This one tiny shift in timing is the difference between a good score and an exceptional score. It's the difference between being approved and being denied. It's the difference between an okay interest rate and a great one that saves you a fortune. You are proactively ensuring that what gets reported to the credit bureaus is a perfect picture of responsibility. You're not letting a random snapshot in time define your creditworthiness. You are taking control of the data. This simple hack alone can easily add 30, 40, even 50 points to your score in the next 45 days as the new, lower balances get reported. But what if you need an even bigger, faster boost? What if you have a thin credit file, meaning you don't have many accounts, or your accounts are relatively new? For that, we need to bring out the heavy artillery. This is a strategy that feels like cheating, but it's 100% legal and incredibly effective. It's called piggybacking, or more formally, becoming an authorized user. Think about what makes a credit score great. A long history of on-time payments, a high total credit limit, and a low credit utilization ratio. If you're young or new to credit, it can take years, even decades, to build that up. But piggybacking allows you to essentially borrow someone else's perfect credit history and have it instantly grafted onto your own credit report. Here's how it works. You need to find someone in your life, typically a parent, a spouse, or a very trusted family member, who has fantastic credit. I'm talking about someone who has a credit card they've had for 10, 15, even 20 years. A card that has a high limit, say $20,000, and they always keep a very low balance on it and have never ever missed a payment. You then ask this person to do something very simple: to call their credit card company and add you as an authorized user to that specific account. Now, here's the critical part. You don't need the physical credit card. They can cut it up the moment it arrives. You are never going to use this account. The magic is what happens behind the scenes. About 30 to 45 days after they add you, something amazing appears on your credit report. That entire account, all of its glorious history, gets copied and pasted directly onto your file. Suddenly, your credit report shows that you have an account that's been open for 20 years. Your report shows that you have access to an additional $20,000 credit limit. And since the balance is low, your overall credit utilization plummets dramatically. The impact can be breathtaking. The age of your credit history skyrockets. Your total available credit explodes. Your utilization ratio craters. I have personally seen this one move at 70, 80, even over 100 points to a person's credit score in under 2 months. For a mortgage lender who sees a borrower suddenly go from a 680 to a 760, It's a night and day difference. It unlocks the best loan programs and the lowest possible interest rates. Now, a word of extreme caution. This is a strategy built entirely on trust. If the person whose card you're on ever misses a payment or runs up a huge balance, that negative information will also report to your credit file and will crush your score. You are tethering your financial fate to theirs. This is why you only do this with someone you trust implicitly, someone who is impeccably responsible. Secondly, you need to be aware that some of the newer scoring models like FICO 10 are getting smarter about deprioritizing authorized user accounts. However, the mortgage industry is slow to adapt. The vast majority of mortgage lenders still use older, more established FICO models like FICO 2, 4, and 5, where this strategy is still incredibly powerful. So there you have it. Two of the most potent credit-boosting strategies that exist: the prepayment method to master your credit utilization, and the authorized user strategy to fundamentally reshape your entire credit profile in record time. By implementing these, you're not just hoping for a good score, you are actively engineering an exceptional one. You are walking into the mortgage process with an undeniable advantage. We've now covered income, we've mastered our debt-to-income ratio, and we've just supercharged our credit score. We have assembled all of the raw materials. We have sharpened every tool. All the preparation is done. Now it's time to finally put it all together. We're going to walk through this together right now. Let's invent a person. We'll call her Alex. Alex is a first-time homebuyer, and she's been following this series, doing the work. She's ready. First, the calculator asks for gross annual income. Alex makes $85,000 a year. So we type in 8-5-0-0-0. No commas needed. Done. Next, it asks for your total monthly debt payments. This is where our DTI work pays off. Alex has a $450 car payment and a $250 student loan payment. That's it. So we add those together, $700 per month. We type in 700. Now the down payment. This is the cash you're bringing to the table. After months of saving, Alex has $40,000 ready to go. A fantastic start. We punch in 4-0-0-0-0. Next up, credit score. Thanks to the strategies we covered, Alex supercharged her score from the high 600s to a stellar 760. The calculator will have drop-down ranges, like 620 to 679, or 740 and above. We confidently select that top-tier bracket. Excellent. This single click will unlock the best possible interest rates. Loan term. For this first run, we'll stick with the most common option in the United States: the 30-year fixed mortgage. It provides the lowest monthly payment and predictability for the long haul. We select 30-year fixed. Finally, the property location. This is more important than you think. The calculator needs to estimate property taxes and homeowners insurance, which vary wildly from state to state, even county to county. Let's say Alex is looking to buy in Texas. We select Texas from the list. Okay, the moment of truth. We've entered the income, the debts, the down payment, the credit score, and the location. Every piece of the puzzle we've spent this entire series assembling is now in its place. We take a breath and we click Calculate. The little wheel spins for a moment, and the numbers populate the screen. And there it is, the big one, the headline number. The calculator estimates that Alex can afford a home with a maximum purchase price of around $350,000. Let's pause and understand what this number means. This isn't the loan amount. This is the total price of the house she could potentially buy. The loan amount would be this price minus her $40,000 down payment. So, a $310,000 loan. But below that headline number is the data that really matters. The calculator breaks down the estimated monthly payment. And it's not just the loan itself. It's PITI, principal, interest, taxes, and insurance. It might show something like this: principal and interest, a little over $1,600. Estimated property taxes, maybe $400 a month. Estimated homeowners insurance, maybe $150 a month. For a total estimated monthly housing payment of around $2,150. This is the number. This is the result of all our work. This is the figure you compare against your monthly budget. For the first time, Alex isn't just dreaming about a house. She's looking at a concrete, tangible number that connects her financial life directly to a price tag on a home. The abstract has become real. But here is where I need you to listen closer than you have in this entire series. This is the most important secret of mortgage qualification. The number the calculator gives you, that $350,000 home, that $2,100 payment, is the bank's number. It's the absolute maximum the financial system thinks you can afford without a high risk of defaulting. The bank's number is not your number. The bank does not care if you can still afford to save for retirement. The bank does not care if you have money left over to go on vacation, to handle a surprise car repair, or to simply order a pizza on a Friday night without checking your account balance. The bank cares about one thing: your statistical ability to pay them back. Your job is to find your number, the number that allows you to own a home and live your life. So what do? We use this calculator not as a final answer, but as a dynamic tool. We start playing with it. We use it to find our comfort zone. Let's say Alex looks at that $2,150 payment and says, "You know, that feels a little tight. I'd be more comfortable around $1,900 a month." Great. Now we work backward. We can use the calculator to figure out how to get there. What levers can we pull? First lever, the down payment. What if Alex's parents offered to gift her another $10,000? Let's change the down payment from $40,000 to $50,000 and hit recalculate. Boom. The total home price she can afford at that same monthly payment jumps up. Or for the same $350,000 house, the monthly payment drops by about $60 or $70. We're getting closer. Second lever, debt. Remember that $450 car payment? What if Alex had a savings account she could use to pay off the last $8,000 of her car loan? Let's go back into the monthly debt field and change $700 to just $250, the student loan. We hit recalculate. The change is massive. Her borrowing power skyrockets. Suddenly, that $350,000 house comes with a monthly payment that's hundreds of dollars lower. It's well within her $1,900 comfort zone. Seeing this on a screen, the power of eliminating a debt before you buy a home, is a game-changing revelation. It's not just a theory anymore. You can see the cause and effect in real time. Third lever, the home price itself. This is the most obvious one. Maybe the answer isn't a bigger down payment or zero debt. Maybe it's a slightly smaller house or a home in a neighborhood with lower property taxes. We can lower the purchase price in the calculator, bit by bit, $340, $330, $320, until the estimated monthly payment hits that magic $1,900 number that feels right for her budget. Do you see the power here? This tool transforms you from a passive passenger into an active pilot of your own financial future. You can run dozens of scenarios. What if interest rates go up 0.5%? Plug it in and see the impact. What if I get that $5,000 raise at work? Plug it in and see how much your affordability grows. This calculator is your financial flight simulator for homeownership. You can test different approaches and see the outcomes, all without any risk. And that brings us to the final step. This calculator, as amazing as it is an estimate. It's a highly educated guess. Its purpose is to give you a realistic price range to begin your search, to prevent you from falling in love with a $500,000 home when your budget is closer to $300,000. It's a tool for setting expectations. Your true final official number will come from a human being, a loan officer or a mortgage broker. Once you've used the calculator to find your comfortable price range, your next step is to talk to a lender for a pre-approval. They will verify your income with pay stubs, pull your actual credit report, and give you a rock-solid number you can take to a real estate agent. But you will walk into that conversation with confidence. You won't be asking, "What can I afford?" You'll be telling them, "Based on my research, I'm looking for a home around this price, with a monthly payment I'm comfortable with. Let's make it happen." You're no longer a novice, you're an informed, prepared homebuyer. We started this journey in a place of confusion, overwhelmed by a process that felt complex and intimidating. We broke it down piece by piece. We demystified income, we conquered the debt-to-income ratio, and we took control of our credit score. We've replaced anxiety with knowledge and fear with a plan. This isn't just about numbers on a screen. It's about building a future. It's about finding that place where you can hang your pictures, make your memories, and build your life. It's about turning the dream of a front door with your name on it into a tangible, achievable reality. So now it's your turn. Open a new tab. Find a mortgage qualification calculator. Don't be afraid of it. You understand how it works now. You know what every single box means. Plug in your numbers. Play with the scenarios. See what's possible. Your journey to homeownership doesn't start with an open house. starts right here with this simple, powerful tool. You are more ready than you've ever been. You've got this.